Welcome to Build Wealth, Retire Rich What Is series. Have you ever wondered how a company goes from being privately owned to having its shares traded on the stock market? That process is called an initial public offering or IPO. And today we are going to break it down in a simple and easy to understand way. What is an IPO? An IPO or initial public offering is a process where a private company sells shares to the public for the first time. This means that anyone, investors like you and me, can buy a piece of the company on a stock exchange such as the New York Stock Exchange or NASDAQ. But why would a company decide to go public? Well, there are three main reasons. Number one, to raise capital. Going public allows a company to raise a lot of money from investors, which can be used for expansion, research, or paying off debt. Number two, to provide liquidity. Early investors and company founders can finally cash out some of their shares. And three, to boost credibility. Being publicly traded can make a company look more established and trustworthy in the business world. How does an IPO work? So how does an IPO actually happen? It's not as simple as just deciding to sell shares. There are several key steps involved. Step 1. The company decides to go public. A company decides it needs more money and wants to raise funds through an IPO. Step 2. Hiring an investment bank. The company works with an investment bank, also known as underwriters like Goldman Sachs or Morgan Stanley, who help determine the share price and market the stock to potential investors. Step 3. Regulatory approval and roadshows. The company must file documents with regulators like the SEC, Securities and Exchange Commission, and go on a roadshow, basically a marketing tour to attract big investors. Step 4. Pricing and IPO day. The final stock price is set, and on the IPO day, shares start trading on the stock market. If demand is high, the stock price can jump right away. Now the big question, should you invest in IPOs? Here are some pros of IPOs. Potential for huge gains. Some IPOs see big first day price jumps like Facebook and Google. Early opportunity to invest in a future giant. More transparency. Public companies are required to disclose their financials. But there are some risks also involved with IPOs. So risk of IPOs, prices can be volatile. Some IPOs crash after the initial hype, lack of history, new public companies don't have a track record in the stock market. IPOs are often overpriced due to hype, meaning they may not be the best investments right away. An IPO can be an exciting event both for the company and for investors. But as with any investment, make sure you educate yourself, analyze the risk, and invest wisely. If you found this video helpful, hit the like button, subscribe, and drop a comment below. What's the most exciting IPO you've ever followed? Thanks for watching, and I'll see you in the next one. Thank you.